Let's go over 3 stocks that we're looking at this month. And we're going to talk about different stock picks, but remember, stock picks are only 10% of the process. The other 90% is how you actually manage these positions. So that's more of what we're going to talk about. That's what we do in these videos. First up is Zoom, which is, an obvious one. This thing has just had a massive run during this whole CCPV crisis. And if you look at our TSI scanner, Zoom is actually number 1 on the list. And this TSI scanner basically tells us which stocks have the highest momentum in the market. The idea being, if we can isolate those stocks, then obviously we can invest in them and make sure our money is always in the stocks that are the strongest. And if something has high momentum, there's a very good chance that it's going to continue to run higher. And this TSI scanner that I'm talking about is just one of the tools that we use in our overall strategy. And that strategy is what we teach in this free training. There's a link in this video and down below in the description and comments. You can check it out because a lot of what we talk about in this video will go into more detail in this training. It's free and it'll teach you the strategy that I'm using as well as all the members in our Fallible group. Now, like I said, Zoom is number 1 on our TSI list. But of course, the question that everybody has when they look at Zoom, like when you look at this stock chart, you're wondering how much higher is it really going to go? And this is the same question I had when we got in on June 1st. I was like, this thing already ran. What can really happen from here? But if you know that the momentum is really strong in this stock, literally the strongest in the stock market, then there's a higher probability that this thing will continue to run. And that's kind of the point of a momentum strategy. You're trying to find these outliers who don't just go up a little bit, but they go up a lot and they keep going. And that's what momentum is, right? Upward price movement leads to more upward price movement. It's the best way to ride trends, and trends continue to gain strength as they trend in one direction. Eventually, of course, the trend does turn around, but it's not going to turn around just because you feel like it's ran enough. And like I said, I feel like that too. A lot of times when I'm entering a new stock with my strategy, it looks like it already ran so much, I'm like, no, this thing isn't going to run anymore. But I put that bias in the back seat and I just execute. Because if I didn't, then I would have missed out on all these gains that we've had since I entered. And like I said, I get that feeling for a lot of stocks, which is why I ignore it, because if I did listen to that feeling, not only would I miss out on Zoom, but the strategy itself wouldn't be doing twice as well as the market right now. So the moral of the story, like I've said in all of these videos, is that you stick to the strategy as long as it is a sound strategy. It needs to have an edge. And how do you determine whether a strategy has an edge? Well, there's a few ways you could do it. You could run it over a period of years, and you could also backtest it. And all backtesting is saying that, okay, I have a certain set of rules, and if I executed these rules over this period of time through all these different market scenarios, things happen every day, how would my returns be? And a set of rules is basically an algorithm, right? So you're just testing that with data. Now, of course, when you're putting together a strategy, there's a lot of stuff you can do to just find random patterns. You could basically data mine, and you can say, okay, yeah, this pattern is going to work. I mean, I don't know why it works, but sure, it works. It goes back all this time, and then you start executing it. And then you could run into a problem where all of a sudden it craps out. Something weird happens in the market, and you end up losing a bunch of money. That's why not only do you need a data mined edge, but you need something that actually makes sense within the context of how markets work. So in our case, what I was talking about is momentum, right? And when it comes to momentum, going back hundreds of years, they have studies showing that it works year after year. Because momentum, when you think about it, it's really a universal law, right? Why do sports teams go on hot streaks? Why do you go on a hot streak in your personal life? When things are just all working well for you. Sure, some of it is random probability, but another part of it is momentum. So in the stock market, when you think about momentum and how psychology comes into play, think about what happens as a stock price continues to rise. It attracts the attention of more investors, and those investors start piling in their money, and because they're buying, the stock price continues to rise. So what is created? A positive feedback loop, right? More investors see those other first investors making money, so they start putting their money in as well, and you get that loop, and it keeps going and going. The whole boom bust system that we go through in the economy, it's basically doing the same thing with these stocks on a smaller scale. So that's why when we think about the edge of this particular strategy, you can say, okay, it does make sense. It fits within the rules of the market and really life in general. Now, like I said, we're investing in a trend, right? But what eventually happens to a trend? It turns around. So you got to have good trade management in place, like what I was talking about before, so you can ensure that you don't lose all your money when the thing turns around. So one of the things that we do in our strategy is take profits as the stock keeps hitting targets, as it keeps going higher. That way, you're hedging your bet a bit. You're locking in gains because the truth is, even if you're invested in a great stock and it keeps going up, that money isn't even yours until you actually sell the stock. It can be gone like that if things turn around. So good trade management is taking profits on the way up, getting while the getting is good. So like I said, we got in on June 1st in Zoom right here, and within a few days, the thing already jumped up above 20%. It was like 2 days. And that 20% was our first target. So at this level right here, which was June 3rd, like I said, 2 days later, we sold 25% of our position. So say we had 100 shares in Zoom, we sold 25 of them, and we locked in those profits. And you can see we weren't the only ones who did it. The stock took a little dive after that. And I shouldn't call it a dive, it's really just a minor consolidation. But you never actually know, right? The thing could turn around. Like, this could have been a turning point. Fortunately, it wasn't though. But if it was, you know, we would have already locked in some gains. And yeah, Zoom was number one on the TSI ranking this whole time, but that's not like 100% predictor that the thing is going to go straight up. It greatly increases the probabilities in your favor, but there's nothing in the stock market that's going to predict what happens 100% of the time. There's no prediction in the stock market. It's all about probabilities. You're making bets. So that's one reason we take profits at that first target. But we don't sell the entire position because we know, because of the probability, you know, of this having high momentum and being number one, the probability is in your favor that it'll run higher. So you're kind of managing both sides, right? You're hedging your bets. So take some profits, leave the rest on. And sure enough, what happened? It consolidated a bit and then it went higher. So our next target was hit on June 22nd. And at that point, that's when we sold another 25%. So again, if you had 100 shares, you'd sell another 25 shares. So by this point, you've sold off half your position that you started with, and you got those profits in your pocket. Will it turn around here? Who knows? As of today, it's still up. And of course, you got to remember that stocks only go up because of Powell. I'm kidding, but yeah, the market does look pretty strong right now. Either way though, I'm following my strategy and I'm taking those profits. So you can see, regardless of what happens to the trend, we're managing our position, making sure that if things do turn around, we're going to be okay. Now, another thing that's really important when it comes to trade management is your risk point, meaning the point that you set that you know you're going to sell at. So when we got in on June 1st, we put our risk point 15% below our entry point. So if the stock didn't go up and it dropped 15%, hey, we would have sold everything. But what we do as we hit targets and we take profits is we pull that risk point up. So we hit our first target on June 3rd, right? So we took 25% of our profits, but we sold 25% of our shares. And then we pulled that risk point from 15% below our entry to our break-even point. So where we entered, which was right here, June 1st. That way, if this was the end of the run and it turned around and started dropping, we would be out at break even. So we would break even on 75% of our shares. Let's just say 75 out of 100. And we would have profits on 25. So we would still come out green in the end. And the thing is, how many times has it happened to you where you were in a great stock, but then you hold on too long and all of a sudden it's dropping back below where you bought it? So not only are all your profits gone in a really great stock, but you have a loss too. It absolutely sucks. It's a round tripper. That's what we call it. Super creative name. So to prevent that from happening, that's why we pull those stops up. And we continue to pull them up. So when we hit the second target on the 22nd, we pulled our stop up to the first target level, which is right here. So now if things turn around, we're not going to go back to break even, but we're going to go back to the point where our first target was. So yeah, by this point, we have 50 shares left. So on that 50 shares, when it drops below this level right here and we sell, well, on that final 50 shares, we would have made a 25% gain too. That's the power of trade management. And that's why it's 90% of the game, because stocks are great, like picking good stocks, right? But really what it comes down to is how you manage them. When are you buying? When are you selling? And again, we go into more detail about all this trade management stuff, why it's so important, how to put it together, and you know, the whole strategy in this free training. Definitely check that out today. Now, the great thing about the strategy that I'm using is that it's all quant based. So I don't have to do any research. It takes me like 15 minutes a month to execute. And it's gotten like 1500% returns since 2008. So I'm pretty happy. But like I said, the reason it takes so little time is because it's all automated. It's an algorithm. Now in Zoom's case, and honestly in all these stocks cases, it's very good for me, but especially Zoom, because I am so biased against this stock. I just hate this company. And if I let that bias interfere in my investing, then I would have missed out on all these gains. And the reason I dislike Zoom so much, other than the fact that I don't like Zooming with people, is that it's a CCP company, and CCP is the Chinese Communist Party. So the company Zoom has over 700 employees and multiple R&D centers, all based in China. And here's the problem with any companies based in China. The government is all up in them. So the CCP, they have a hard, heavy hand over whatever these companies are doing. So in Zoom's case, if they have data centers and all sorts of stuff over there, then who's looking at all our stuff here in the US? The CCP, of course, right? They're known for intellectual property theft, which is honestly the lightest thing among all the other things that they're accused of, and the human rights violations, all this terrible stuff. So even in their 10Ks that Zoom publishes, they warn investors that they're going to face scrutiny because their data security is in question, and you've already seen them in the news for this all over the place. Their CEO was also born and raised in China, which means there's a good chance that the CCP has a tight grip on him. Of course, we can easily tip into conspiracy theories here, which I know some of you listening are already thinking, yeah, AK's crazy. But from what I've been told from people who are way more familiar with all this geopolitical stuff than I am, is that whether they like it or not, a lot of Chinese have to answer to the CCP regardless of where they're living, especially if they're in a position of some power, which, you know, Zoom Zoom has completely taken off. And it's sad because these people don't really have a choice. Now, of course, is that proven? No, I can't say it is. But regardless, the fact that so much of Zoom is based in China is not a good look. And they've proven that over and over again as they continuously bend over for the CCP. So a few weeks ago, Zoom shut down Tiananmen Square Memorial Zoom sessions. And they did it because obviously China doesn't like those. So they were like, no, don't have that. And not only did they shut down those meetings of those people, but they also banned the users that were involved in it. And not just Hong Kong based users, but US users as well, which is ridiculous. Now, they did reinstate these users after all the criticism, but who are they working for here? The CCP? So I was very happy to see some senators sending letters to Zoom asking, hey, what's going on with you guys? Why don't you pick a side? Are you a US company or are you a Chinese company? So my bias is if we're in a new Cold War with the CCP, then I want companies like Zoom just getting smacked. They should get shut down and thrown off our exchanges unless they want to keep things safe and in the US. I'm not down for those crazy guys in the CCP monitoring everything that we're doing. So that's my bias, right? And if I'm reading all this news and keeping up with what's happening with Zoom, then I would be out. But look at this stock price. Look at how crazy this run up has been. The market is always going to know more than me. And clearly this whole CCP thing is not a factor, at least not yet. That's why we talk about fallibility on this channel and not having an ego, because most of the time we're going to be wrong. We need to throw out our biases, admit that we know nothing, and follow what the market is telling us. You're not smarter than the market. Always got to remember that. Now, do I think Zoom is eventually going to turn around and crash? Yes, I do, based off our macro research and macro ops and where things are headed. But again, you want to play what's in front of you versus what you think is going to happen in the future, because time frames are already hard enough in the market and this thing can run so much higher before that happens. But yeah, I'm spending way too much time on Zoom, but I think it's a good example of why you need a strategy or a system that takes out these biases, because I hate Zoom and I hate the CCP. But all these things running in my head doesn't mean I got to shoot myself in the foot when it comes to returns in the market. I do way better taking my biases out. And I know that's true for most people. It's something we all struggle with. But okay, second stock I want to talk about is Tesla. You can see right here that it's number 2 on the momentum ranking list. Now, the last time I talked about Tesla in one of these videos was on June 3rd, right here. And I was saying that there's a little mini consolidation happening here and you could wait for a breakout and potentially get in. Sure enough, we got that breakout, and if you got in, you would have made some money. And now after another leap, we're looking at another mini consolidation. And this is just basic technical analysis, right? Support and resistance levels, which just give you a clue into what the psychology is of the stock. Now, in our strategy, are we playing every one of these little breakouts? No, because we are more long-term. So depending on your strategy, you could have been buying on all these little jumps, which if you're a shorter term trader, you probably are doing. And in retrospect, this looks pretty easy, but of course it's not that easy in the heat of it, but hopefully it's easier if you are sticking to your strategy. In our case, we're actually holding on to the last portion of our position, the last 25%. And you can see I got a bunch of writing on this chart because in that training that I was talking about, we actually go over how we managed this whole thing through that big market crash that we experienced and how we got back in. So again, you could check that out in this training. But like I said, we're holding on to the last portion of our position because it already hit 3 targets. And that's again what I like about this strategy, because again, with the momentum, you're trying to find these outliers, right? So you don't want to take all your profits off as the thing is running higher, because that's what you were looking for. It doesn't happen too often. There's not so many Zooms and so many Teslas. So we do take a lot of profits, but we always leave a piece, at least 1/4, to keep on running, because who knows how far this thing will go. You want to take advantage of that, and you'll see even that little portion, letting it run, really adds to your bottom line. It's a huge help for returns. And being number 2 on the TSI scanner list at a TSI of 48.42, it's likely gonna keep running unless the entire market turns. And I'm looking forward to it because you know I'm a big Elon fan. Now, the next stock that I want to talk about is Dexcom, DXCM, which, oh, big surprise, number 3 on the TSI scanner list. High momentum stock. This one we got in on June 1st, but you can see it didn't work out right away. It actually fell once we entered, and now it's recovered a bit, but compared to our other positions, this is a laggard. And that's the thing, no strategy is going to be perfect, but over time, if you keep executing trades with a positive edge, you should make money. Doesn't mean all of them are going to be winners. In fact, most strategies have more losers than winners. Now, the reason I love having a strategy set in place, because normally if I was discretionary and, just flying by the seat of my pants, which is what I used to do, I would see this little down move in DXCM after I entered and probably exit, because you know how it is. I mean, I'm sure you felt this too. You start getting impatient. Like, this thing has been going sideways for almost a month now, or I got a little bit of gain on it, but not enough to make me want to stay in it. I'm trying to find another non-CCP Zoom to make a bunch of money in, but my strategy tells me to stick in it. And there has been so many times in the past where, I felt the same thing, impatient patient, but I stuck to my strategy, and sure enough, it might have taken a little longer to take off, but the stock does eventually shoot higher. Will that happen in this case with Dexcom? I don't know. It does have that high momentum reading, you know, it's high up on the TSI list, so the probabilities are indeed in its favor, but we never know with this stuff. So I'm not gonna worry about it, which again, another benefit of having a strategy is I don't gotta worry about it. The strategy has my back, it's taking care of things, it's already proven. I can go relax. Well, maybe not relax because we're all surrounded by the CCPV constantly, but you know, whatever you want to call it. Basically just not look at the stock market. But I do like Dexcom as a company. They create medical devices for people with diabetes. So instead of pricking their finger to check their blood glucose levels all the time, there's a little device that they have that constantly monitors glucose and sends messages to their phone. And it'll give them alerts if something's out of balance. It's pretty cool technology and people love it, which is probably why you see the stock price moving like it is. It's a pretty nice trend. And that's why it shows up as number 3 on the TSI. And that's the beauty of using price, because whatever is going on in the stock, whatever people are feeling about it, it's going to be reflected in the trend. So again, if you're interested in using this strategy yourself, and I think I've given a pretty good preview of it, if you want to learn more on how to use it to profit, just check out that training. Link in this video and down below in the description and comments. And if you like this video, make sure you subscribe for more. We're publishing a whole bunch of them. So do that, and I will see you in the next one. Stay fallible out there. Bye.